Welcome to the Deep Dive. Today we're really digging into a quite complex set of results. We're looking at Zenvia's Q2 and first half 2025 performance.
Yeah, these numbers came out after the bell on September 10th, and then the conference call was the morning after, September 11th.
And the market reaction was, well, pretty immediate and pretty brutal, wasn't it?
Oh, absolutely. The stock just cratered. So our mission here is to figure out, what's going on? How can you have this really strong top-line growth hide such a dramatic, collapse in profit?
It's a real head scratcher. Let's just lay out the key numbers first because the contrast is quite something. Revenue was $285.7 million for Q2.
Which is solid. That's up 23.6% compared to last year. So, on the surface, looks like they're grabbing customers, getting volume.
They're capturing that Latin market. And it's a big but. That seems to be where the good news kind of stopped cold.
Yeah, the market looked straight past that to the bottom line. And it wasn't pretty. GAAP EPS, a loss of $42.0 million for the period.
Okay, so a net loss. Concerning, but maybe explainable with growth investments.
Maybe, but then you hit the adjusted EBITDA. That just plummeted. Down 68% year over year. 68%. Landed at only $10.7 million.
Wow. 68%. That screams efficiency problems. Big ones.
Exactly. And you see it crystal clear in the consolidated gross margin. It just got crushed. Dropped 1,810 basis points year over year.
1,800 basis points. So what did it fall to?
Down to 19.7%. Barely breaking even on a gross level for the overall business.
Sub 20% gross margin when you're growing that fast.
Oh,
that's setting off alarm bells for investors, surely. Raises questions about sustainable growth.
It absolutely does. And that profitability issue flows directly into, a potential liquidity crunch. That's the immediate worry.
Right. The cash flow. What did that look like?
Operating cash flow burn was negative $25.0 million for the quarter.
Okay. Burning our $25 million and their cash position at the end of the quarter.
Only our $32.6 million.
Oof. So you burn almost as much cash in one quarter as you have left in the bank. That's a tight runway.
Super tight. So you put it all together, decent growth, terrible profitability, burning cash fast. It's no wonder the stock reacted so violently. That 25% drop makes, a certain kind of sense in that light.
Okay, let's unpack this. We need to look at the segments because Zenvia really has two different businesses under one roof, right?
Exactly. You've got the communication platform as a service, CPaaS, which is the volume side, and then the software as a service, SaaS, which is focused on their strategic Zenvia Customer Cloud, or ZCC.
And the story seems to be completely different for each.
Totally divergent. CPaaS is the big engine right now, 72% of the total revenue, and it grew like gangbusters, up 33% year over year to $205.1 million.
So the CPaaS top line is humming, getting those customers in the door.
Definitely.
But here's the trade-off, and it's brutal. The adjusted gross margin for CPaaS just, it fell off a cliff.
How bad was it?
Down to 11.8%. That's a drop of 2,570 basis points compared to last year. Just staggering. 2,500 basis points. So they basically sacrificed all margin to get that volume.
Seems like it. Management had a couple of explanations. First, they said they deliberately took on some big clients that just have inherently lower margins. A scale play, maybe?
Okay. Chasing volume. What else?
Second, and maybe more critically, they got hit hard by increased carrier costs, especially SMS costs. That's a big input for them.
So external cost pressure, too. That makes it tricky. Were they passing that cost increase on?
Oh, that's the key point. They said they are passing those higher SMS costs through, but it's happening throughout 2025. It's not fully done yet.
So the margin hit reflects costs they haven't fully passed on to customers yet. That's a timing issue, potentially.
Potentially. And that leads to their big promise, the one the market seems really skeptical about right now.
Which is?
They expect CPaaS margins to, quote, normalize closer to 20% by the fourth quarter of this year, once those pass-throughs are complete.
Okay, hold on. Normalize back to 20% from 11.8% in basically 2 quarters by raising prices.
That's the plan.
In the Latin American CPaaS market, which is notoriously competitive. That sounds incredibly difficult, like a really high-stakes bet. What if competitors just undercut them?
That's precisely the risk everyone's worried about. It's not a given they can push those price increases through without losing volume. It's a really tough balancing act. If they fail, the cash burn just keeps going.
Okay, so massive risk on the CPaaS recovery. Meanwhile, what about the other side? The strategic future, the SaaS business and ZCC.
Right, the higher margin part. That segment brought in $80.6 million. But the growth there was, pretty sluggish, only 3% year over year.
Only 3%. For the part that's supposed to be the future, that's not exactly setting the world on fire.
No, it's not. But the quality of that revenue is much, much better. The adjusted gross margin for SaaS was strong, 55.4%, actually ticked up a bit year over year.
55% margin. Okay, that's what you want to see.
Oh. Exactly. And management really tried to focus attention on the Zenvia Customer Cloud, the ZCC platform within SaaS. They said that specific part saw revenue up 23% in the first half of the year, so accelerating from Q1.
Okay, so ZCC itself is growing faster. It's just maybe masked by other parts of the SaaS segment.
Seems to be the story they're telling. And they stuck to their full-year guidance for ZCC revenue growth, still targeting 25% to 30%.
So they believe that ZCC momentum is real, even if the overall SaaS number looked weak this quarter. How do they connect the two, though? How does low-margin CPaaS feed high-margin ZCC?
That's the strategy, right? CPaaS is the entry point. It's cheap messaging, gets the customer onto the platform, generates data. ZCC is the integrated suite, the customer data platform, analytics, automation tools.
So land them with cheap SMS, then upsell them the fancy high-margin software suite.
Pretty much. Show them how unifying everything on ZCC can actually improve their business. They said they're seeing this work, especially with SMBs, and getting some initial enterprise traction too, despite, competition in Brazil's enterprise SaaS space.
Okay, so the brutal CPaaS margin is essentially like a really high customer acquisition cost for ZCC.
You could definitely frame it that way, but that acquisition cost is draining through their cash. So they have to get costs under control elsewhere, like yesterday.
Which brings us to OpEx, operational spending. What are they doing there?
They're cutting hard.
Yeah.
Management stress, OpEx discipline. G&A expenses, general and administrative, were down 25% year over year in the first half. That's a big chunk.
25% reduction? Is that sustainable? And what's the target for the full year?
They're aiming for $30 million to $35 million in G&A reduction for all of FY25. And remember, this comes after they already announced a significant 15% workforce reduction back in January.
Right, they cut staff significantly. So this aggressive cost cutting is a smart financial discipline, or is it kind of panic mode, cutting so deep they might hurt their ability to actually build out ZCC?
That is the million-dollar question, isn't it? It's a real risk. You cut too deep, especially in R&D or sales needed for ZCC, and you undermine the whole strategy.
So how does management justify it? How do they avoid cutting muscle?
Their answer seems to be technology. Specifically, AI. They mentioned AI multiple times, saying it's key for service delivery, but also for making their internal operations more efficient.
So use AI tools to do more with fewer people. Trying to keep innovation going while slashing overhead.
That seems to be the gamble. Leverage AI to bridge the gap created by the cost cuts. It's a big bet on AI delivering immediate productivity gains.
And this all ties into the CEO's longer-term picture.
Exactly. He painted this vision, 2 to 3 years out, where the company looks totally different financially, less volatile, low-margin CPaaS, more stable, high-margin recurring revenue from ZCC.
He's framing this rough patch as a necessary transition, turning into an AI-powered SaaS company.
That's the narrative. But like you said earlier, that 2 to 3 year vision doesn't matter much if they hit a wall with liquidity before then.
Right back to the cash. That our $25 million burn versus our $32.6 million cash on hand, that has to be front and center for investors, the runway.
Absolutely. And management knows it. That's likely why they proactively brought up their deleveraging strategy on the call.
Deleveraging, what did they say?
They said they're actively looking at options to sell off non-core assets. Opportunistically, they said, to strengthen the balance sheet.
Selling assets.
Yeah.
That sounds like they're preparing a backup plan if the margin recovery or cost cuts don't work fast enough.
It certainly sounds like a contingency. And the CFO even threw out a potential data point, mentioned that sometimes historical deals for CPaaS businesses have happened around 1x revenue.
1x revenue for CPaaS assets. So they're signaling they could sell parts of that low-margin business to raise cash, buy themselves more time for the ZCC transition.
That seems to be the implication. It gives them another lever to pull if things get really tight.
Okay, so if you're watching Zenvia now, you're basically betting on management pulling off a pretty tricky maneuver over the next, say, 6 months.
A very tricky maneuver. It hinges entirely on execution.
So what are the absolute must-watch things, the key catalysts we need to see turn positive in Q3 and Q4?
I'd boil it down to 3 critical things. First, clear proof that CPaaS margin is recovering. They have to show progress towards that 20% Q4 target. That validates the whole pass-through strategy.
Okay, CPaaS margin normalization, number 1.
Second, adjusted EBITDA needs to start improving sequentially. Show that the cost cuts are actually working and stabilizing the bottom line.
Right. Stop the bleeding on EBITDA. What's third?
Third, ZCC growth needs to keep accelerating. They need to hit or get very close to that 25-30% full-year target. That proves the strategic shift is actually happening and gaining traction.
Got it. CPaaS margin, adjusted EBITDA improvement, and continued ZCC acceleration. If those don't happen.
Then the liquidity pressure just mounts and things could get very difficult very quickly. The asset sale talk becomes much more urgent.
Okay, let's shift gears. Time for a thought experiment segment. Definitely not financial advice, but let's put on our hypothetical aggressive trader hats.
All right, high risk, potentially high reward thinking here. The setup is obvious. The stock got hammered, down 25.5% in one day, trading at pretty depressed levels.
So the market's clearly pricing in a lot of bad news, right?
Yeah.
Maybe assuming failure on the margin recovery or serious liquidity problems ahead.
Exactly. So the outrageous but plausible thesis is the market overreacted. It threw the baby out with the bathwater.
Okay. The idea being that the market focused only on the temporary margin hit and the cash burn and completely ignored the aggressive cost cuts and the actual positive signs in ZCC growth.
That's the core of the thesis, that the problems are severe but maybe transient and management can fix them.
So what's the trade idea based on that?
It's a bet purely on execution and timing. You'd think about, hypothetically, a highly leveraged, time-bound, long position.
Leveraged and time-bound. Okay. Targeting what?
Targeting a recovery in the stock price, maybe back towards those pre-earnings levels, let's say $1.79 or higher, by the end of the year.
Ambitious. And what makes this trade work? What are the explicit triggers?
It's entirely contingent on management delivering. They must hit that Q4 target of 20% CPS margins, and they must deliver the full $35 million in G&A savings they promised.
So it's a direct bet that the cash burn stops, the pass-through works, the cost cuts stick, and ZCC keeps growing enough to reassure people before they run out of time or are forced into a fire sale of assets.
Precisely. You're betting management can thread this very fine needle in a tough environment. It assumes the current low valuation is just panic, not a reflection of imminent disaster.
Definitely high risk, high reward if they pull it off, but a lot has to go right.
Absolutely. It's banking on that CEO's 2 to 3 year vision, having some near-term credibility.
So wrapping this up for you, the listener, Zenvia presents this fascinating, but also frankly worrying picture. You've got strong growth colliding head-on with a profit and cash crisis.
Yeah, the entire story now hangs on their ability to execute this transition. Shift to the high-margin ZCC, fix the CPaaS margins, and cut costs effectively, all at the same time.
The volatility isn't going away anytime soon, not until we see clear evidence on those three catalysts we mentioned: CPaaS margin, EBITDA, and ZCC growth.
That uncertainty is definitely what's weighing on the stock price.
And I'll leave you with this final thought to chew on. That huge 25.5% drop after earnings, was that the market correctly pricing in a very real risk of failure and liquidity issues? Or did it overshoot, basically pricing in the zero chance that management could actually pull off this turnaround plan? Where the truth lies on that spectrum is really the key to valuing Zenvia right now.